Hello everyone, this is Carter Finance. Today we're going to be talking about the beta. What is beta? The inverse of that, so negative beta. Also different hedging options and shorting. We're going to be talking about that today. So what is beta to me? Beta to me is the speed at which a stock will move. Just get some definitions out of the way or other things out of the way. The S&P 500 is an index. Now the beta of that index is 1. So we talk in terms of the whole market moving at a beta of 1. So the S&P 500, the top 500 companies move at a beta of 1. Let's get that down. So if the stock market, so the S&P 500 moves up by 10%, if it had a beta of 2, it would move up 20%, so twice as fast. That's why I talk about speed. Now, kind of on the other side, if the stock market or the S&P 500 went up by 10%, it would only go up by 5% here because it's only half as fast. And if it was at 0%, it wouldn't be anything because it's not correlated. And that would just be the risk-free rate, so like a T-bond or treasury bond. But that's in a different part of the video. Now on here, that's just beta explained. I kind of already explained it, and I'll go into later detail on my second slide. So here, let me move my camera over a little bit more so we have a better view. What I did here is I took Walmart with a beta of 0.48 versus the SPY, which is the S&P 500 index fund. So I did these cash flows in the future. I actually did the average beta predict in the future. That doesn't really matter. We're talking about current moments anyways. So in 2022 has a beta of 0.53. Actually, I did the beta of 0.48 here. So if the market were to decline at 10%, what would happen to the SPY and what would happen to Walmart? Now, the SPY would decline by 10%. It would go from 447 to 402. Now, Walmart would only decrease by 4.8% because it's less volatile. This is a very good tool for hedging your losses in your portfolio. If you're older, you're a financial advisor, you should have a financial advisor setting up risk and parameters. Now, let's kind of go into the next section. Now we're going to be talking about what is negative beta, negative and zero beta. So I made a little chart here. XYZ is some random stock. The SPY is the SPY index. I don't want to have to keep saying that, so hopefully you guys kind of catch on. So the beta is -1. What does that actually mean? It means if the SPY goes up by 10%, it has an inverse effect. So it actually goes down by -10%. This is a great way to hedge against inflation. Hedge against the market, because if the market goes down by 30%, then this is going to go up by 30%. It's literally just the opposite. It's reflective. If you remember the reflective property in mathematics, so I don't want to get into that. I fear mathematics. I'm just kidding. Now, if I had a beta of 0 look like, if the stock market went up 10%, there would be no correlation. If you went back to the second or the last, like at least 30 seconds ago, I had just showed you a chart of what would happen. There's no correlation, and that would equal the risk-free rate, also called the weighted average cost of capital. There's a lot of different metrics to kind of call it, but anyways, you can get 2% from a treasury bond. Now, a beta of 1 is just a market. So if the market goes up 10%, the stock that's at a beta of 1 also moves up 10%. Now, if it's at a beta of 2, the stock market moves up 20%. We already talked about this. And this random stock would move up 20%. I think I explained it pretty well. Hopefully that makes sense. Now, we're going to get into the more complicated part of the video, or maybe not. It depends on how I explain it. So what is hedging? I hear a lot of talk about hedging, and a lot of people don't have the right idea of hedging. They think pouring more money into a position is hedging. That's not hedging. That is gambling. the same people that think they can do 5 hours of research and pick a stock versus an actual equity analyst that does 100 hours of research on a stock. Only one is doing due diligence. You can pick which one. So actually, how to hedge. You can short the S&P 500 or buy put options. So what is shorting? We're going to go into what is shorting. This could have been a separate video, but I felt like it was necessary. So when you short a stock, you are buying on margin, which means you are basically borrowing shares. A margin account allows you to basically get leverage. So you go into a margin account, you put down $1,000, and they'll allow 2-to-1 leverage. So you put in $1,000, and they'll give you $2,000 to play with. Just don't get margin called. Anyways, so you're going to sell. You first have to sell these shares out at $350, so $350. And when you short, you actually want the price to go down. You might not have known that when the price goes down, you can actually make money. So shorting, it goes from $350 all the way to $330. You're happy because you just made $350 minus $330, and you just made $20 per share. Now you take $20 times, you shorted 20 shares. Really good job. So that's $20 times 20 shares, which equals $400. That's the best case scenario of how shorting works. And it's not that easy, because I'll explain why. Now, you do the same thing. You sell these shares out on a margin account at $350, but it doesn't work in your favor because there's a new announcement. The drug got FDA approval. In this case, it wouldn't move that much. It would move a lot more. So $350 minus $370 equals negative $20. You only lost $20, but you bought 20 shares of it. So now you're negative $400. That is how shorting works. Okay. So buying put options. When you buy a put option, you are paying a premium to buy this put option. It's not the same as shorting. You're not paying a premium. The thing about buying put options is I usually would like to sell them, but there's unlimited. You can lose unlimited amounts of money when you short a stock or when you sell a put. Both are very dangerous. That's why you should read a lot of books, read a lot of articles on actually how to do it, or talk with an option specialist on this, or watch YouTube videos. That works as well. So you can do that. So you can increase the cash in your account. This is just simply like kind of market time. You can sell off assets, sell off stock, and kind of wait for good moments. Now you can buy VIX calls. What is a VIX call? It was made by the Chicago Board of Options Exchange. What it allows you to do is bet on volatility. And we talked on volatility because it's basically just the speed at which a stock moves. And we already talked about that. So, and then also TIPS, Treasury Inflated Protected Securities. Protects you against inflation. So if inflation goes up 3% each year, they got you. Very nice thing they made there. Now the pros and cons of hedging, or risky hedging at least. There are safe ways, and I have that, conservative and risky. So risky, the pros of it. You can have great returns. You can make a lot of money timing the market. You could take advantage of the coronavirus that happened. One hedge fund manager named Bill Ackman actually made $2.2 billion or $2.8 billion basically hedging the market. He did very, very well. He also tried to short Herbalife, and he failed at that. And it happens. So anyways, the cons are hard to predict the market. The other pros, this kind of be funny, but to tell your family. Might sound funny. I guess the only thing you can do is tell your family. They won't know what you're talking about. But that's cool. You can tell your friends. They probably don't know what you're talking about. They probably don't care. Another cons. The market just trades sideways, and you lose the money on your put option because you have to pay a premium. So if it doesn't hit your strike price, then you lose money because you paid a premium. You don't actually lose money on the option. You just lose the money that you paid to have that option. So you probably lost a few $100s, maybe per contract. Depends on the option pricing model. Now, the pros, there's risk and there's a reward dynamic. You can there's a limit. I wish I would have made a Venn diagram because it probably would have been better. Because I would have wrote here, and then in the middle, I would have put risk and reward dynamic. Because you can limit your risk and you can have rewards as well. But it's kind of in the middle because you're having best of both worlds, but you're not getting lots of returns. But you're also not going negative a certain way. So anyways, we talk about what is shorting, the pros, cons, how to do it in a risky way. Now let's talk about in a conservative way that I would advise probably everyone to do. Dollar cost averaging. Buying the SPY once per month, buying index funds once per month might be the best way to actually make money. Real money. Let me show you why. Let's just say in 2008, after the financial crisis, you bought when it was at $72, and then you bought every month after that, and you just kept buying, and you just kept buying, and you just kept buying. Your returns, and especially if you buy during the 2020 coronavirus crash or pandemic. So you see that buying over the long term is better than just buying a lump sum right here, and then you see it crash, and then buying a lump sum here, seeing it rise, and then buying a lump sum here, buying $10,000 here, $10,000 here, $30,000, $50,000. You should just be investing $200 per month through this time period. Now let's get back to the Excel spreadsheet. So that is DCA. Dollar cost averaging, or buying an index fund and you don't have to buy an index fund. You can buy your Microsoft shares, your Tesla shares. And another thing is just trusting the process of dollar cost averaging, or whatever your process is. Another conservative idea is I like reading the RSI. What is RSI? Relative Strength Index. If you see here in 2008, 2009, mostly 2009, it had an insane decrease to where the RSI was at 20. So if the RSI is at 30, that is telling you to buy. If it's at 50, it's telling you it's at moderate. And if it's at a 70, then it's telling you it's oversold. So if you see right here, it was saying let's move that out of the way. It was saying it's oversold right here, and the market did indeed go down. So it corrected itself. Right here, it's pretty high, decreased a little bit. That might only be like 5%. The market was really high right here. It was at an 86 RSI, and it decreased down here. Right here, I probably wouldn't be able to predict this, but it was right around that mark where it was almost overvalued, and it decreased down to around 41 RSI. So that is using RSI to your advantage. I have a lot more alternatives, but I don't want to make this video way too long. It's probably 10 minutes plus. Now bonds. Bonds are just simply a great way to not just diversify, but to, I would say, secure your capital. Your inflation is probably 2%, or 2 to 3%. Bonds get around 2%. You can get corporate bonds. Let's just say you average 3% on bonds. Also, another one I could have added is fixed income. Fixed income typically has low beta, maybe like the 0.75 range, the 0.5 range, to where it's not as volatile, and you're getting dividends on top of it, which is very, very nice. Thank you guys for watching. This is Carter Finance. If you could like, subscribe. If you like these videos, if I can be better at teaching, or if you want me to explain something, please write a comment. And you're free to like and dislike the video. Both help with engagement, but constructive criticism would always help. And if you have any questions or you want any help, just send me a message here in the comments that I'll answer. Thank you, and have a good night.